Hi, good morning. We'll do a mic test now. If you can hear me and if you can see the screen, please let me know. Okay, I've got a positive response. Thank you for that. So we'll start the webinar now. So as you can see, we are having some sector report today, as well as company results and some of our weekly musings. Okay, our disclaimer. Okay, we'll start with land transport sector. We published our report last week. We're maintaining overweight on land transport sector. Same reason as the previous month. Positive industry restructuring, and the worst is over for the taxi industry. Taxi population has reached an inflection. I'll show the chart for that in a later slide. And rental cars population has started to contract. We also see robust momentum for taxi driver vocational license issued in the month of September, and this suggests underlying demand for taxis. Gojek is slated to launch in November this year, and it will be partnering car rental firms, and he has commenced registering drivers for their platform. All in all, we maintain accumulate on ComfortDelGro with unchanged target price of 278. So some of the data from LTA, as usual, the same four data points as taxi population, rental car population, number of valid taxi driver license holders, as well as the number of licenses issued. So from the table, you can see that for taxi, year on year is lower by 13%, and year to date, 8% lower. Rental cars wise, has increased 1.4% year on year. This year on year growth has been plunging. So I'll show the chart for that later. And the silver lining is that year to date, rental car population has actually contracted 2.5%. In terms of number of license holders to drive taxis, there's been a year on year is 1.4% higher, and year to date there's been an increase in number of license holders by 2.6%. For number of licenses issued in the month of September, there was a 500% increase over last year. And then for the first 9 months of this year compared to last year, there's a 180% increase. Okay, so I've mentioned this in the previous slide. So Gojek is going to launch in November, and based on media report, they'll be partnering 6 rental firms to supply vehicles. And more recently, they have also launched an online portal for interested drivers to register for their platform. So for these news data points, there are positives and negatives. So first, taxi population is showing a year-on-year contraction, but this contraction, the rate of this contraction has slowed and in fact starting to U-turn. I'll show the chart later. And then based on the current rate at which rental car population is contracting, we think that it by the end of this year, we'll see a year-on-year decline as demand shifts back to taxi. And then number of TDVLs issued also remains robust. As you recall, last month it made a new high, and then for September it made a new high again. And so this should translate to demand for taxi by taxi hirers. And then although there should be some short-term pressure when Gojek enters the market, but it should not be as significant or prolonged as what was observed during the Grab and Uber era. on the negatives is that there was a month-on-month decline in the overall taxi population of 0.4%. But having said that, take note that the combined taxi fleet for Comfort and CityCab actually increased month-on-month. Okay, so the chart on the left shows the taxi population and the rental cars population. So you can see that taxi population peaked around 2015 and it had declined 20% so far, and now it's starting to stabilize. In contrast, you can see that for rental cars, it's starting to decline already. And then the chart on the right shows the year-on-year change in the respective population. So first, we talk about the taxi. You can see that while it reached almost a negative 18 or 19% earlier this year, that rate of decline has slowed down and now is starting to bottom and U-turn. And then in contrast, for rental cars, the population growth rate had stagnated since 2017, and now it has plunged. So what this shows is the rental cars population has stagnated already. And then if you extrapolate this growth rate, it would be possible to have a year-on-year decline already by the end of this year. Next, the chart on the left shows the number of taxi driver licenses issued. So you can see the dark blue line, that is the number of licenses issued, and it's up here at 850 in the month of September. And recall that previous month in August, it was about 600 plus. So the light gray line also shows the year-on-year increase. So now it's at about 500. For the number of valid TDVL holders, that grew 2.6% year to date. That's the dark blue line here. And then this chart shows the average daily ridership for Northeast Line, Downtown Line, and the Sengkang Punggol LRT. So you can see that right here at the end, for the last 3 months, that is July, August, and September, average daily ridership maintained above 1.2 million. That is about a 26% increase, largely driven or mainly driven by the opening of Downtown Line 3. So with this, what you can expect for SPS Transit is that the losses for Downtown Line should taper quite quickly. And don't forget that there was a fare increase granted by the PTC as well. So that should accelerate the recovery for Downtown Line.
Thanks, Richard. Hi, this is Paul here, but just Minion is busy in the DBS conference call now, so I'll just do a brief on the Singapore banking stats. Okay, on the banking stats, basically, what is happening is that the loans growth momentum is still there. As you can see, it's growing at 5.6 at a similar pace of from the prior month. What's helping loans is, of course, business loans and also a consumer. In terms of deposits, there was as you can see, the red line was the noticeable change was because fixed deposits is seen a big spike as interest rates are rising. Most of the banks are taking the opportunity to try and hoard up or bulk up on fixed deposits before the rates start to rise even further. This was one of the reasons that kind of hurt UOB Bank's net interest margins. I'll move on to net interest. Net interest continues to still be at elevated levels. This will give pricing power for the banks. Likewise, we see a similar increase for Hong Kong net interest margins. Just to summarize it, we still favor the banks. We don't see any major deterioration in terms of loans growth, although it's slowing down slightly, but nothing to. It's only in Hong Kong that we do see some slower loans growth coming out of Hong Kong, below our target prices. So we still maintain a buy on the banks. Move on to the UOB results. I think the key message, which of course hurt the share price, was of course the net interest margins. Again, I think the company has flagged out very clearly that they are bulking up on deposits, fixed deposits, which everyone knows is more expensive, and that's why you're having a short-term drag in terms of the net interest margins. The other one, in terms of some of the positives, I think despite the drag in margins, you still see interest income growing at about 9% year on year. As you can see, the total revenue grew about 8%. And also the other positive is that they are very well, they are in a way overcapitalized. You can see the CET ratio one, which is the ratios for the amount of equity they have, is about 14.5. I think they are comfortable with 13 to even to 13.5. So they're holding excess excess capital, and that's the reason why they will definitely pay much better dividends for this year. Not much change in terms of our outlook. Okay, we'll move on very quickly. Sorry, I'll move on to OCBC. I guess the key message for OCBC was that we saw net interest margins recover strongly in the third quarter. The reason given by the management is that they've been a bit slower or intentionally slower in terms of raising the prices or interest on the loans. This is to just give the customer some time to adjust to the higher interest rates. I think the negative for OCBC is, of course, the expenses. You can see the expenses actually outpace their total income, which is the revenue. That's the reason why the cost to income ratio is declining. So this is one of the things that we are watching for OCBC, is how they're going to control the expenses and not to raise too much fixed costs. Okay, same thing for our no change into our outlook, we cut our target price slightly just in view of the volatility and also the slower growth environment. So we adjusted a bit of our beta and cost of funds, cost of equity. Sorry. Okay, again, I'll move on to Mingin's Raffles Medical Group. Sorry, she's busy with the DBS conference call now. But anyway, just to give you some key highlights. I think what has done well for the revenue is basically the clinics business has done well. Again, hospital, as we can see from the industry data, has been sluggish. As we mentioned before, sluggishness is due to medical tourism and also some market share loss to the public hospitals. What has been helpful is that they maintain to contain costs pretty well, especially in view of their expansion in Raffles Specialist Center, and also as they're coming up with the new China expansion. So the ability to control costs has been a positive for us, for Raffles Medical. Okay, in terms of the key thing to watch for will be, of course, the upcoming Chongqing Hospital. They've guided some EBITDA loss, but I think the market's already factored them in. So the key outlook will be on the hospital that's going to be open end of 2018. Again, for Raffles Medical, the two big stories as we move forward to the next 2-3 years will be China and also insurance. This will be their two new pillars of growth. But in the near term, of course, there'll be some short-term hit on their earnings as they move into these two new sources of growth for Raffles Medical. I'll move on next to Guangzhou to discuss about China Aviation.
Hi, it's Guangzhou here. So next I will give update on China Aviation Oil's third Q results. So we maintain our buy call with a lower target price of $1.76. If we take a look at the results here, except the the top line, which grew by 21%, mainly due to the higher oil prices. The profits from associates and joint ventures and also the net profit actually decreased moderately. So the reason is during this quarter, the supply and trading volume actually decreased. You can see the table here. So the reason was partially because of the trade war. Actually, the trade war indirectly impact the business. Right now, the management is reviewing the crude oil trading and supply business. Why? Because as we knew that the trade war happened in 2Q, and after that, from US side they stopped purchasing jet fuel from the domestic refinery, the teapot refineries. That means CAO could already stop accepted the offtake from the domestic teapot refineries. So moving forward, there could be high chance that they will suspend the crude oil supply to the domestic market. That means the supply and trading volume will decrease substantially in 4Q and next year. So also the profit from associates, you can see mainly due to the decrease in profits from Pudong. That was because due to the FX losses resulting from the devaluation of RMB. So for the outlook of CAO, it could be a little bit gloomy because as I said, the trading volume could drop moving forward, and also if RMB continue to depreciate, the rising FX risks could be a headwind for the whole business. So next, I will pass on to Paul again.
Okay, thanks, Guan Zhou. I'll move Paul here again. So I'll just move on to Sheng Siong's results. In terms of the results, the two key stories were basically the, revenue performed really well, 8%. Most of the growth, at least 10 percentage points, came from the new store growth. And because they are opening record stores, record 10 stores for this year. So what has happened is also they're obviously taking market share from other supermarkets. As you can see that the third quarter is tracking for -2%, but Sheng Siong grew about 8%. The other key news was, of course, the gross profit remains very strong. It's a record gross margins for them for the September quarter. The negatives for us was the same store sales. As you can see, in second quarter, the same store sales was actually 4%, but this sharply fell to 0.2%. Some of the reasons given was, of course, weaker consumer sentiment, and the other is increased competition in their older store. Their definition of older store or same store sales growth is those shops older than 2 calendar years. So these are stores open 2016 and before. And also, there's also one of the reasons the weakness is also the declining resident pool. I think, but the main news is of to why the headline numbers was down, at least of the EBIT, was because despite the rise in gross margins, as you can see, gross profits was up about 6 million. But what happened was that they had to bulk up, or at least they had to expand their staff, their admin cost, which is majority staff cost, by 6 million. So whatever growth that came from the revenues was all absorbed by the increased headcount. As you know, all these new stores, although they are not matured, you need to have some minimum staffing levels at the shops. So as a result, they wiped out any rise in the gross profits. In terms of the headline numbers, why the profit was down 9%, This was due to a 2.2 million tax credit in the prior quarter. So net, the earnings was actually growing probably like down 1%. In terms of recommendation, we still like the company. And we maintain our target price despite reducing earnings, because we think earnings will be resilient in 2019. 2019, you're going to get the full year benefit of the 10 new stores, and they continue to gain market share. And we still like, because it's a 25% ROE business with a net cash balance sheet. Okay, I move on to the next stock, Micromechanics. Micromechanics is part of our SGX paid research program. Okay, in terms of Micromechanics, the main news was as you can see in red, was the decline in revenues. What was meaningful was that this is their first year-on-year, not deceleration, but decline in 2 years. And also, what was the positive thing was actually the gross margins actually maintained, despite the weaker top line, they actually still maintain very strong gross margins at almost 60%. So in terms of a recommendation for this, we still maintain a buy, but obviously there's going to be a cyclical slowdown for them in FY19. But we still like it because this company has one of the most attractive metrics, like highest gross margins and ROE in the whole semiconductor back-end industry, and they pay an attractive 5% yield. So as a result, we actually cut our target price, but we still have a buy on this stock. Okay, I'll move on to the next, which is me again. Basically, our weekly updates for week 45. In terms of Singapore, our US updates will all be covered by our analyst Edmund in the following slides. But anyway, for week 45, I think what we see in terms of Singapore macro has been the PMI new orders that came out for Singapore. It was 53.6. This is probably the third month of deceleration. But although there's weakness, it's not. When we looked at how the PMI looked at a year ago, it was actually quite at a similar level. So although activity is slowing down obviously in Singapore, but it's not at a very alarming rate. Okay, in terms of the corporate news, we did attend AGM for Creative Technology. Just to give you some flavor, we don't cover this stock, but I guess it's one of the most talked about stocks. But anyway, the highlight, obviously, the one that has been in discussion by everyone is the launch of their Super X5 headphone amp. Okay, anyway, in terms of the marketing, they won't be using offline distributors, basically the brick and mortar distributors. They are going to be, because it's very expensive to sell to this channel. They are very demanding in terms of rebates and all the marketing support. So what's happening is that their creative is going to sell online directly. The key for them will be to create some viral marketing, and also to let the early adopters use the product. The reason for doing this is, of course, apart from the offline distributors being expensive, it's challenging to sell the product experience. I think what they mentioned was that, this is not like a TV where you can see the benefits of the TV clearly, but for this product, the benefits are not obvious. You really have to try the product. So it will take some time to get the early adopters and to get that buzz. And they need to get some media buy-in and to get the positive publicity surrounding this product. In terms of this product, in terms of talk about how, apart from selling directly, can they sell the chip or solution to other headphones or mobile phone operators? I think that is a channel that they want to sell to. But I think for them, having been in this thing for almost 30 years, I think they need to create the market first. Otherwise, to get better terms from all these headphone or mobile phone makers, if you do not create the proper buzz or market for this product, I think you'll get very poor terms if you sell the chips to them. So again, it's all back to square one. It's all about getting this product popular before taking the next stage, selling the chip or solution to other mobile phone or actually headphone makers. Okay, I'll move on to the next topic, which is basically our tactical. I think, as we all know, it's all about the midterm elections right now. So using the base case scenario that we mentioned before of the Republican losing their lower house majority, again, you'll get a lot of investigation, impeachment, and subpoena noise. So this is going to be a negative for the US market. And also, you're going to less likely to get that $1 trillion infrastructure stimulus. although the Democrats have also proposed for this, but again, like we mentioned before, it's unlikely the Democrats want to have a 1 trillion stimulus just in time for Trump 2020 elections. So we think that's very unlikely. And the scenario is that if this happens, they lose the lower house, this could actually be a weaker US dollar environment, and this could in a way kind of be positive for emerging market and also even Asia. And but again, the key thing now is that it's unclear about the talks about negotiations with China by Trump. Is this just is this just to boost the stock market and form some pre-midterm elections? We really don't know because they never negotiated or discussed anything until the last few days when he said he had a phone call with presidency. But anyway, we move on. In terms of our stock picks, again, we are looking for some defensive dividend stocks, which is basically defensive against a rising yield environment. So stocks that can have at least some earnings growth and fend off against the rising interest rate environment. So these are some of the names. And these are some of the key events that's going to be happening. Okay, next I'll move on to Chair Yan. He'll talk about China. Thanks.
Thanks for China last week. For the fiscal policy side, there is 3 things you need to pay attention. Firstly, on Wednesday's meetings, China's removed the restrict like deleveraging and the destocking. And from the President Xi's talking, from President Xi's talkings, we can tell the government focused on helping the listed private companies to finance and help them to continue operating. For the methods, President Xi mentioned there will be a tax cutting and particularly fund for help these kind of companies. Secondly, last week China released a government document about improve the weakening of infrastructures industrials. Thirdly, on Thursdays, the President Xi and Trump had phone meetings, and on Fridays, Trump said he will make a deals with the Chinese. So we're thinking G20s will be the beginnings of the new round of the China-US talk. For the economic indicators, China's October PMI is 15.2, lower than expectation. This is because of the new orders, the decreasing new orders and the manufacturers numbers. Although there is we see downside pressures on the China's economic because of the positive fiscal policies, we are seeing the market confidence are regaining. Last week, the Shanghai complex up about 3%. So we are looking forward to the offset effect of the fiscal policies. For the stock recommendations, our Hong Kong research teams to recommend H&H and Shanghai Farmers. This week we are looking forward to China's October CPI and PPI numbers and foreign exchange reserve. I will move. And I will move on to Paul for the U.S. weekly musing.
Okay, it's me again. Okay, anyway, the reason is because Edmund is also out for another meeting. I'll just do the summary for him. Okay, I'll move on to US. Okay, from every week onwards, Edmund is our US analyst, so he'll give an update on what's happening in the US. Okay, but anyway, in terms of the macro, I think everybody knows, I think the average hourly earnings actually hit a decade high, so that's a positive. The only curious thing is that as we look forward, manufacturing activity is just slowing down in the US. I think I'll skip all this. Just news flow of Apple and also Alibaba and Exxon's results. But I think he did a summary. I think this is an automated process that we did. That he did just on the results. So in terms of the EPS, this is all the earnings released for the tech sector. So when we did a check on in terms of EPS earnings, like who surprised the most, actually Amazon did the best, up 40%. And in terms, the weak one was actually Facebook, was actually -4. So actually tech sector, most of it actually did pretty well in terms of beating estimates. In terms of the revenue estimates, more or less in line, is about 0.1%. Facebook was a bit lower than estimate, but I think key was the profitability. And also, Amazon. Facebook actually disappointed also on the revenue for the September quarter. I think what was interesting for him, at least, was that Amazon's earnings was due to lower costs, and key is the 30% growth in their AWS or cloud solution. So for him, I think this looks quite sustainable for Amazon. In terms of the guidance, Amazon, there was no EPS guidance given, but in terms of the revenue for Amazon at least, it got sold off quite strongly because of the weaker expectations. I think prior to the release in the fourth quarter, December quarter, this was what the market was expecting. This is what the market was expecting, but this was the guidance. So they actually got sold down because of a 5% below their revenue guidance. But again, I think you will see a stronger profitability out of Amazon. The one that the guidance with the weakest guidance was actually Netflix. They guided much lower profit and also much lower, not much lower revenues. I just quickly move on. In terms of this is not the December quarter, it's the September quarter. In terms of the financials, most of the financials actually, this is not negative, this is actually positive. Most of the financials actually did pretty well in terms of in terms of beating their earnings. As you can see, almost all the financials beat their earnings, and even the guidance by the financials, even the revenues also beat the guidance. So actually financials in terms of the September quarter numbers actually did the best in terms of earnings. It's also revenue. Okay, that's it for us. If you have any questions, please post them. Thank you. Okay, sorry, we got one question. Possible to go back to previous slide for Singapore defensive stocks? Yeah. Okay. Yeah. Okay. Sorry, give me a second. Okay. Anyway, yeah. This is the slide. This is SGX UOB Capital Commercial Trust. Again, we are just looking for. Okay, the question was possible to go back to the previous slide for Singapore defensive stocks. Okay, these are the stocks. The rationale why we're saying is just that in the rising yield, as we move into 2019, we're going to have to factor in 100 basis points move in interest rates. So we got to figure out like what stocks are going to be at least the most resilient. And worst case scenario is 100 basis point rise or 1 percentage point increase in interest rates. At the same time, you got all the tariffs that seem to be escalating. So in this kind of environment, base case environment, what are the stocks that we think can at least ride out through? So for that, they need to have good yield, and also we expect at least yield to take a step up, or at least can at least sustain the dividend yield even though interest rates are rising. So these are some of the stocks that we have. Oh, okay. DBS, sorry. DBS is just DBS having the results call now, so that's why Mini is not in. Yeah. Why do you not have more REITs as your defensive dividend stocks? Okay, that's a good question. Again, because when it comes to rising dividends, rising interest rates, REITs, as you know, get hit twice. They get hit because as a yield play, they will lose out to higher interest rates because REITs are considered almost like a bond proxy. So if REITs are rising, then you're going to have the valuation will actually be suppressed. And the other part is that REITs, as you know, are quite leveraged. Although most of them have already kind of hedged out their interest rates, but they are one of the most leveraged stocks or companies out there. So as a result, they will get hit from these two aspects because of the higher interest expense, and also as a bond proxy, they will lose out to a higher interest rate environment, or when government bonds become higher, so they turn more expensive. So in the end, we only have one of them we had is CCT, is mainly because who can have the strongest rental reversions or rental growth to kind of offset these two upcoming headwinds. Yeah, sorry to give you a long answer. Yeah. Can you hold on? We got some questions. We're just trying to compile them. Thanks. Oh, sorry, give us a second.
There is a question asking about the drop in contribution from Shanghai Pudong due to currency alone. So yes, the decrease was partially due to the FX losses. If we look at the refueling volume, year to date, the Shanghai Pudong International Airport has 3.4 million tons of refueling volume, compared with last year's 9 months of 3.23 million tons. So in terms of the volume, actually was quite flat. So the explanation is during this quarter, there was higher operating expenses as well. So that is why the profit from Pudong dropped moderately, or double digit, high teens. Yeah.
Yeah, there's a question on Gojek and rental cars. So the question is, why is it forecasted going forward rental car population would decrease, especially with Gojek commencing operation in Singapore? Would there be a repeat whereby there's a mad rush by rental car firms to purchase cars for Gojek, like the Uber case? Okay, so first of all, I said that if the momentum continues, then there would be a decrease. Yeah. And then for the question about rental cars, buying new cars, if you read the news, there's actually a lot of rental cars which are unhired out all over in the car park. So probably the number of rental cars in aggregate already has reached saturation already, and there's an oversupply even based on today's demand. And so if that's the case, then even if Gojek comes in, probably if there are new drivers who join the industry, then they probably first have to soak up the unhired rental cars that is left idle in all the car park around Singapore.
So follow up the questions regarding CAO. So there is a question asking about the jet fuel volume has dropped to around 4 million versus 4.4 million last year. And why is this case when the international air traffic is still rising? So we knew that oil prices went up to more than $80 per barrel during third Q this year. So if we look at the futures chart, actually the backwardation continue during 3Q. So when the market is under backwardation, the CAOs has reduced the trading position and supply volume because the future jet fuel prices is lower than the current spot prices. So that explains why during third Q, the supply and trading volume decreased by around 10%. And also I want to highlight the air traffic. Actually, we do monitor the number of flights handled in Shanghai Pudong International Airport. Actually, during third Q, the number of flights they handle was quite flat. That means it's just slightly above the number of flights they handle during third Q 17.
Okay, we have another question. Thank you. With the uncertainty going forward, would consumer staple sector, counter like Sheng Siong, which also give good dividends, be a good sector to invest? Yeah. I think we still like Sheng Siong. I think for them, they got the benefit that although it's a consumer staple and they actually are growing, so it's one of the probably rare consumer staples that's also growing, maybe 3-4 times the market, the market, I guess, if you want to because we still looking at a high single digit revenue growth for them, because they are it's not only the stores that is expanding, it's also the sales per square foot. So there's some productivity gain too for them. Yeah. So we like Sheng Siong on that aspect. Yeah. Thank you. Yeah. Okay. Thanks everyone for participating. I don't see any other questions. If nothing else, thanks everyone for attending and for all your questions. Yeah. See you next week. Thank you. How to end it? Yeah.